and welcome back to Boni's Life, the channel where we cut through the noise and empower you with the financial wisdom to build a better future. Today, we are diving deep into a topic that could fundamentally change the way you look at the stock market, not just in the United States, but globally. We're talking about a single metric so powerful, so insightful, that it has been the secret weapon of some of the greatest investors in history. Yet it remains criminally underutilized by the average person. I'm talking about the price to earnings to growth ratio, or as we call it in the inner circle, the PEG ratio. This is the metric that separates the amateurs from the professionals, and today I'm going to hand you the keys to this powerful tool. Forget everything you think you know about stock valuation. For years, you've been told to look at the PE ratio as the go-to metric for determining if a stock is cheap or expensive. But here's the truth that Wall Street doesn't want you to know. The PE ratio only tells you half the story. It's a snapshot in time, a static photograph of a company's past performance. The PEG ratio, my friends, is the full motion picture. It doesn't just tell you what a company is worth now. It gives you a glimpse into what it could be worth tomorrow. It's the key that unlocks the relationship between a company's stock price, its earnings, and most crucially, its future growth potential. In this episode, we are going on a comprehensive global journey that will transform how you evaluate investments. For the beginners watching, I'm going to break down the PEG ratio step by step, making it so simple you could explain it to a fifth grader. For my advanced traders and seasoned investors, we're going to explore the sophisticated nuances of the PEG ratio, including its more advanced cousin, the PEGI ratio. And then we're going to do something you won't see anywhere else on YouTube or in any financial publication. We will dissect real-world up-to-the-minute examples from the titans of both the US and Chinese markets. We'll put Nvidia, Apple, Microsoft, Amazon, and Tesla head-to-head with their Chinese counterparts like Tencent, Alibaba, BYD, Qatar, and Pinduoduo. This is not just theory. This is actionable global intelligence. So grab a notebook, silence your notifications, because your financial education is about to get a serious upgrade. Let's start with the absolute basics. Before we can run, we must learn to walk. And in the world of stock valuation, walking begins with understanding the price to earnings ratio, or PE. The PE ratio is the most common metric used to value a company. It's calculated by a simple formula: the company's current stock price divided by its earnings per share, commonly known as earnings per share. So if a stock is trading at $100 per share and its earnings per share over the last year were $5, the PE ratio would be 20. This means you are paying $20 for every $1 of the company's earnings. A lower PE is generally seen as better, suggesting a cheaper stock, while a higher PE suggests a more expensive one. It's a simple, straightforward snapshot of how the market values a company's current profitability. But here's the problem with relying solely on the PE ratio. It's static. It's a photograph of a company's past performance, offering no insight into its future trajectory. A company might have a high PE ratio making it seem expensive, but what if it's growing at an explosive rate? Conversely, a company with a low PE might look like a bargain. But what if its earnings are stagnant or, even worse, declining? This is where the PE ratio fails us, and where the genius of the PEG ratio comes into play. It takes the simple PE ratio and adds the crucial dimension of growth, transforming a static metric into a dynamic one. The PEG ratio was popularized by the legendary investor Peter Lynch, the man who ran the Fidelity Magellan Fund from 1977 to 1990, achieving an average annual return of 29.2%, more than double the S&P 500's performance during the same period. Think about that for a moment: 29.2% annually for 13 years. Lynch turned a $20 million fund into $14 billion, and one of his core principles was the PEG ratio. Lynch argued that the PE ratio of a fairly valued company should be roughly equal to its growth rate. This simple but profound idea is the foundation of the PEG ratio. The formula is elegant in its simplicity. You take the company's PE ratio and divide it by its annual earnings per share growth rate. The result is a number that gives you a much more dynamic and insightful view of a stock's value. Let's break down the interpretation according to Lynch's philosophy. A PEG ratio of 1 is considered to represent a company that is fairly valued, where its PE ratio is in line with its growth. A PEG ratio of less than 1 suggests that the stock may be undervalued. You're paying less for each unit of earnings growth. This is the sweet spot that value and growth investors are constantly hunting for. On the other hand, a PEG ratio greater than 1 suggests that the stock may be overvalued. Its price has outpaced its earnings growth prospects. It's a simple framework, but it's incredibly powerful for quickly identifying potentially mispriced stocks in any market around the world. To make this crystal clear, let's walk through a hypothetical example. Imagine we have two companies, Company A and Company B. Company A has a stock price of $46 and an earnings per share of $2.09, giving it a PE ratio of 22. Company B has a stock price of $80 and an earnings per share of $2.67, resulting in a higher PE ratio of 30. Now, if you are only looking at the PE ratio, you might conclude that Company A is the better buy because it's cheaper. But let's bring in the growth dimension. Let's say Company A's earnings grew by 20% over the past year, while Company B's earnings grew by a staggering 50%. Now, let's calculate the PEG ratio. For Company A, we divide its PE of 22 by its growth rate of 20, which gives us a PEG of 1.1. For Company B, we divide its PE of 30 by its growth rate of 50, and we get a PEG of 0.6. Suddenly, the picture is completely different. Company B, despite its higher PE ratio, is actually the more attractive investment from a PEG perspective. Its stock price is not keeping up with its explosive growth, suggesting it might be significantly undervalued. This is the power of the PEG ratio. It forces you to look beyond the surface and consider the engine of growth that will drive future returns. Now, for my advanced traders and seasoned market participants, let's peel back another layer of the onion. The simplicity of the PEG ratio is its strength, but it also hides some important complexities that you need to understand. The most critical variable in the PEG formula is the G, the growth rate. Which growth rate should you use? A historical growth rate, known as a trailing PEG, or a future estimated growth rate, known as a forward PEG? Using a historical growth rate is easy and objective, but it can be misleading if the company's growth is expected to accelerate or decelerate significantly. Using a forward PEG, based on analysts' consensus estimates, is more forward-looking, but it's also subject to the uncertainty and potential biases of those forecasts. The key is to be consistent in your approach and to understand the assumptions baked into the growth number you are using. Furthermore, the standard PEG ratio has a blind spot. It doesn't account for dividends. A solid dividend-paying company might have a lower growth rate, leading to a higher PEG ratio that makes it look less attractive than it actually is. This is where an even more advanced metric, the PEG ratio, comes in. The PEG ratio, also championed by Peter Lynch, refines the PEG by adding the dividend yield to the growth rate in the denominator. The formula is PE divided by the sum of earnings growth rate plus dividend yield. This gives a more complete picture for mature dividend-paying companies, allowing you to compare them more fairly with high-growth stocks that don't pay dividends. It's a subtle but important adjustment that can help you uncover hidden gems in the market. But even with these refinements, we must acknowledge the limitations. The PEG ratio is not a silver bullet. It works best for companies with stable, consistent growth. For cyclical companies, whose earnings swing wildly with the economic cycle, the PEG ratio can be volatile and unreliable. For very high-growth tech companies, especially those in the pre-profitability stage, the PEG ratio is simply not applicable because you can't divide by zero or negative earnings. A negative PEG resulting from negative earnings or a projected decline in growth is a major red flag, but the number itself becomes meaningless. Therefore, the PEG ratio should never be used in isolation. It is a powerful tool, but it must be part of a comprehensive analytical toolkit that includes looking at the company's balance sheet, cash flow, competitive advantages, and the quality of its management. Now, let's move from theory to practice. This is where the rubber meets the road. Let's use the PEG ratio to analyze some of the most talked about stocks on the planet using real up-to-date numbers from January 2026. Let's start with the undisputed king of the AI revolution, NVIDIA. As of mid-January 2026, NVIDIA is trading at around $187.89. Its PE ratio, based on 2025 actual earnings, is a hefty 63.84. A PE of over 60 would make most value investors run for the hills. It seems incredibly expensive. But let's look at the growth. Analysts are forecasting a PE growth rate of 51.17% for 2026. When we divide the PE of 63.84 by this growth rate, we get a forward PEG ratio of approximately 1.25. While not in the undervalued territory, it's not as outrageously expensive as the PE alone would suggest. Some sources looking at a 5-year expected growth rate even report a PEG ratio for Nvidia as low as 0.70 to 0.91. This tells us that while Nvidia's stock price is high, its phenomenal growth rate goes a long way in justifying that valuation. The market is betting that Nvidia will continue to execute and grow at an incredible pace. Next, let's turn our attention to the tech behemoth, Microsoft. As of January 2026, Microsoft has a PE ratio in the range of 29 to 33. Its estimated PE for 2026 is around 28.26. The reported PEG ratio for Microsoft is around 1.75 to 1.79. A PEG ratio approaching 2 suggests that the stock is trading at a significant premium to its growth prospects. Unlike Nvidia, where the explosive growth helps to justify the high PE, Microsoft's PEG ratio indicates that investors are paying a higher price for each unit of its more moderate growth. This doesn't necessarily mean Microsoft is a bad investment, but it does suggest that the stock is priced for perfection, and any slowdown in its growth could lead to a correction. Now, let's look at another one of the Magnificent Seven, Amazon. Amazon is trading at around $238.27. Its PE ratio based on 2025 estimates is about 33.22. Analysts are forecasting a growth rate of 29.73% for 2025, but that growth is expected to slow to 9.64% in 2026. This gives Amazon a forward PEG ratio of around 1.64, with some sources citing it as 1.52. Similar to Microsoft, this suggests Amazon is fairly valued to slightly overvalued relative to its growth. The market has already priced in a significant amount of future growth, and investors buying in at these levels are making a bet that Amazon can continue to find new avenues for expansion. What about Apple, the world's most valuable company? Apple has a PE ratio of around 34. Its estimated PE for 2026 is about 32. However, its PEG ratio, which accounts for its dividend, is a high 2.52. A PEG ratio this far above 1 is a clear indicator that Apple is considered overvalued relative to its growth prospects. Apple is a mature company, and its days of hypergrowth are likely behind it. Investors are paying a premium for its stability, its brand, and its massive cash flows, not for explosive future growth. The high PEG tells us that you are paying a safety premium for Apple stock. Finally, let's look at the most controversial of the bunch, Tesla. Tesla is a story of extremes, and its valuation metrics reflect that. Its forward PE ratio is a mind-boggling 199, with a trailing PE of over 290. And its PEG ratio? Depending on the source and the growth assumptions, it ranges from 5.59 to a staggering 7.43. A PEG ratio of over 5 is in a different universe from the other tech giants. This is a clear signal that Tesla's stock price is not just pricing in future growth, it's pricing in a complete and total domination of the automotive and energy industries for years to come. An investment in Tesla at these levels is a bet on a future that is far from certain. The PEG ratio here is a stark warning. This is a stock that is trading on narrative and sentiment, not on traditional valuation metrics. Now, let's take this analysis global and see how these American titans stack up against the giants of China. This is where things get really interesting, and where you'll gain insights you won't find anywhere else. We'll look at the top 5 investable Chinese companies: Tencent, Alibaba, BYD, CATL, and Pinduoduo. These are companies that represent the cutting edge of Chinese technology and industry, and their valuations tell a fascinating story. First up is Tencent, the social media and gaming behemoth that owns WeChat, the super app used by over 1 billion people. With a PE ratio around 25 and a PEG ratio in the range of 0.76 to 1.39, Tencent looks remarkably attractive compared to its US counterparts. Its valuation is not as stretched, and its growth prospects, particularly in the gaming and enterprise sectors, remain robust. A PEG ratio that can dip below 1 suggests that, despite its massive size with a market cap of over $700 billion, Tencent might still be undervalued relative to its growth potential. This is the kind of opportunity that Peter Lynch would have loved. Next, we have Alibaba, the e-commerce and cloud computing giant. Alibaba's story is more complex and serves as a cautionary tale. Its PE ratio hovers between 20 and 30, but its PEG ratio is volatile, with some estimates as low as 0.45 and others as high as 3.53. This volatility is due to a projected negative growth rate in the near term, a consequence of increased competition from Pinduoduo and regulatory pressures in China. This makes Alibaba a classic case where the PEG ratio flashes a warning sign, demanding a deeper dive into the reasons behind the fluctuating growth estimates. The lesson here is that a low PE doesn't always mean a bargain if growth is declining. Now for the electric vehicle space, and this is a dramatic comparison that will blow your mind. We have Tesla with its PEG ratio of over 5, and then we have its Chinese rival BYD, which has already surpassed Tesla in global EV sales, has a PE ratio between 17 and 22, and a PEG ratio in the range of 0.38 to 0.95. Let me repeat that, a PEG ratio as low as 0.38. This is a stunning contrast. While Tesla is priced for a hypothetical future where it dominates the world, BYD's valuation appears to be grounded in its current massive and profitable growth. The PEG ratio here paints a crystal clear picture. One stock is trading on narrative and hype, the other on numbers and fundamentals. For investors who believe in the EV revolution, this comparison should be eye-opening. Let's continue with the EV supply chain and look at CATL, the world's largest manufacturer of electric vehicle batteries. CATL supplies batteries to Tesla, BMW, Volkswagen, and virtually every major automaker. With a PE ratio between 24 and 44, its PEG ratio is an attractive 0.50 to 0.86. Like BYD, CATL's valuation seems to be lagging behind its dominant market position and strong growth. For investors looking for exposure to the EV revolution, the PEG ratio suggests that the most compelling value might be found not in the car makers themselves, but in the companies that power them. This is a classic picks and shovels play in the EV gold rush. Finally, let's look at Pinduoduo, the social commerce upstart that has taken China by storm and is now expanding globally with its Temu platform. With a PE ratio between 10 and 12, it is by far the cheapest stock among the 10 companies we've analyzed. Its PEG ratio is around 1.14 to 1.21, suggesting it is fairly valued. For a company that has demonstrated such explosive growth and has successfully challenged Alibaba's dominance in Chinese e-commerce, a PEG ratio just over 1 could be a sign of a significant investment opportunity. The market seems to be underestimating Pinduoduo's potential. So, what have we learned from this global deep dive into the world of the PEG ratio? We've seen that the PEG ratio is an indispensable tool for any serious investor, allowing us to compare companies across different industries and even different continents. The US-China comparison reveals a fascinating divergence. The American tech giants, with the exception of Nvidia, appear to be priced for perfection, with high PEG ratios that suggest the market has already priced in years of future growth. In contrast, their Chinese counterparts, despite facing their own set of challenges, including regulatory uncertainty and geopolitical tensions, appear to offer more compelling valuations from a PEG perspective. The stark difference between Tesla's PEG of 7.43 and BYD's PEG of 0.38 is a powerful lesson in the importance of looking beyond the headlines and digging into the numbers. As you move forward in your investment journey, I urge you to incorporate the PEG ratio into your process. Don't just look at a stock's PE ratio and make a snap judgment. Ask the next question: what is the growth? Calculate the PEG ratio, compare it to other companies in the same industry and around the world. Understand what the market is pricing in. By doing this, you will be miles ahead of the average investor. You will be making decisions based on a more complete, more dynamic, and ultimately more intelligent view of the market. This is how you build lasting wealth. This is how you take control of your financial destiny. Thank you for joining me on this journey today. I hope you found this episode of Boni's Life to be as insightful and empowering as I intended it to be. If you did, do me a favor and hit that like button. subscribe to the channel, and ring that notification bell so you never miss an episode. And most importantly, I want to hear from you. What are your thoughts on the US versus China valuation gap? Are there any other global comparisons you'd like me to make? Which stocks should I analyze next using the PEG ratio? Leave your comments down below. Let's continue the conversation. Until next time, stay curious, stay informed, and keep building your financial future. This is Boni, signing off.